Nir Kaissar, portfolio manager at Unison Advisors and a writer for Bloomberg's Opinion editorial page, all about markets, of course. Nir, you're saying it's like 1998, so if I'm a tech bull, I'm loving that. We've heard some of this case before with the Fed cuts and such, so walk me through it from your perspective.
Good morning, Oliver. You know, when I was looking at it, I was struck by the similarities between 1998 and this year. I mean, of course, you have impeachment. You have 3 Fed rate cuts mid-cycle, despite the fact that unemployment is low and prices appear to be stable. You have a freakishly long economic expansion. I mean, I think some people forget in 1998, the economy had been growing for roughly 8 or 9 years and was just a year away from being the longest ever. And of course, this is the longest expansion ever. We overtook that Clinton era expansion in last summer. And you have tech. And tech, I think, is an interesting one, both quantitatively and qualitatively. Qualitatively, you know, I think you can just say that everything feels like tech now. I mean, every company, no matter what they do, is viewed as a tech company. Amazon is a retailer; they're viewed as tech. Uber and Lyft are great ride-hailing companies; they're viewed as tech. The list goes on, obviously, and this was true in the late 1990s. What's interesting is if you look at the numbers through this year and through 1998. For the prior 5 years in both periods, what you see is then the NASDAQ 100 was the proxy for tech, blew away the S&P 500 in any diversified portfolio. And now I would argue that the comparable the comparable tech vehicle is the FANG index, FANG stocks, and they've also blown away the S&P 500 and diversified portfolios. So you had, you know, this is coincidental, of course, but there's a lot of eerie parallels there.
Now, we haven't even gotten to the big tech explosion, which is blockchain, Internet Part 2. No, I'm just kidding there. I'm just messing with you. a little joke there on a Thursday. So look, the nature of the Fed cuts, though, I mean, that's kind of what is the real core component here, right? I mean, does impeachment have really any kind of role in markets, or is that just kind of a nice little cherry on top for the comparison? I mean, this is about the Fed reversal.
It is. You're right. I mean, it's interesting. The impeachment is what got me thinking about this. I mean, that's really what sort of struck the idea. But yeah, the impeachment is just a cherry on top, as you say. It's I'm often asked whether I think politics has any influence over markets, and I always say, you know, as far as I can tell, it doesn't. There are many examples of this historically, but think back, for example, the one I always like to throw out is the 1960s. Obviously, lots of political turmoil, as much as you can possibly count, and yet it was one of the historic bull markets. So in general, markets don't care about politics unless they have a direct impact on the economy itself. And you could argue that, for example, the trade disputes have both a political dimension and an economic dimension. And so there's a reason why they're driving markets. But aside from that, no, you're absolutely right. The Fed is an interesting one because, and that I think is a direct parallel. Because in both cases, you had an economy that looks healthy. You've got, as I mentioned, you have the dual mandate of the Fed, which is low unemployment, or maximum employment, I should say, and stable prices. In both cases, if you look at the measurements, they appear to be doing their job. And in both cases, you had these so-called mid-cycle cuts. And then what happened next, and this is the part that I think is most interesting, people forget that from December 1998 to March 2000, the NASDAQ 100 nearly doubled in price. I mean, it was just getting going. And people lost their minds. I mean, at that point, because of the mid-cycle cuts, we were talking about a slowdown. We were talking about tech being overdone. We were talking about reversals. And it had just gotten started. And so I think people are not considering the possibility that even though we're having the same conversation today, the stocks that have led the market over the last 5 years, namely the sort of high growthy, fangy type stock, could just be beginning their run, and it could go on for a while longer.
So there's a few things here that look like they might be in our favor, and maybe a few that don't. On the one hand, even though our valuations are again getting expensive in the market, we've still been remaining under 20 with the exception of Jan 18. And obviously the .com era things got up into the 30s there. However, on the economic side, we did have yield curve inversion, which I believe didn't happen until 99 or 2000, right, in the .com era. So how do we sort of weigh these other signs? Is our bond market just so volatile at this point that maybe that signal is not as concerning? Is that what we've been learning the last 4 months?
Well, there's two pieces there, as you mentioned, Oliver. I mean, so let's try to unpack them. One is the valuations. The valuations. What's interesting about the valuations, if you're just looking at PEs, is that they're in this moment they're very sensitive to what your earnings assumption is. If you are looking at forward earnings, the PE is slightly above average, but not particularly concerning. If you're using the trailing 12-month earnings, all of a sudden the PE jumps into the low to mid 20s, and it's a little bit more concerning. And then if you're using the CAPE, which is basically a trailing 10-year average, then it's north of 30, and now it looks very concerning. And so the spread, what I like to keep an eye on is the spread between the forward earnings and the CAPE. And that spread right now is roughly 10 to 15 points, depending on exactly the measurement that you're using. And that's historically high. And what that tells you when that spread is high, what that's telling you is that you've had very robust earnings growth over the last 10 years, which is true. I mean, earnings have grown nominally by roughly 10% a year, which is way above average, the historical average. And the question then is whether that can be expected to continue. If you think that the earnings growth over the last 10 years is something that is sustainable, then the PEs shouldn't worry you much. But if you think that we're going to have mean reversion in the earnings growth, then the PEs become very problematic, and that's a sign that you're going to get some reversion both in the earnings and the price. The yield curve is a little bit different because I think because of the extraordinary steps that the Fed took post the 2008 financial crisis. And this brings us back to a very old debate about why the yield curve. Sorry, Oliver, did you want to jump in on any of that?
Nope. I love what you're saying here, Nir.
So I think with the yield curve, there's an old debate about why the yield curve has been historically, since the Second World War anyway, why it has been reliable. Is it reliable because there's causation between an inverted yield curve and a slowdown in the economy? In other words, is it telling us that basically, banks obviously can't loan money for less than they pay their depositors, and so that could have an impact on the amount of money that they loan. That could tighten the money supply, and it could cause recessions. That's one side of the argument. The other argument is that the inverted yield curve is just an indicia. It's just telling you that the market is worried about a recession, and generally markets are good about their worries. Not always, but often. And both of those things have now, I think, been thrown into some doubt because the Fed, it seems to me, is telling us we are not going to let the yield curve invert. In other words, we're going to do everything we can to keep the yield curve from inverting. And so now I don't know that the yield curve is as good either depending on how you believe, whether you believe it's indicia or whether it's causation. I don't know that either way it has much meaning anymore.
Nir, love this point because I think it's one of the most important questions to answer. A corollary question, I guess, before we let you go here is we're having a conversation right now about the U.S. dollar that I think has reflected this environment of the last 18 months in such a pronounced way. The cuts as a buffer to the rest of the world's weakness that had bonds and stocks moving together in such a fashion that I now wonder if even if there is this kind of economic pickup around the world, does that mean a leadership shift here that would challenge the nature of the tech rally that still could happen according to your 1998 analysis? Because what I see potential for then is, all right, if there is a market that it has to kind of understand the rest of the world's improvement, yields going higher, that might favor a different type of leadership, hence the kind of rotation into value the last couple months. Now, that's been fine for big tech, and I think that's probably fine for the market, but it could be a little bit of a choppier situation than just a dot-com style rally.
Yeah, I think those concerns are well placed, Oliver. And you mentioned several variables there, and I think tech is vulnerable to more than any other sector, and I think this is probably worth pointing out because I think this goes overlooked sometimes. That if you look at the overseas revenues by sector for S&P 500 companies. Tech relies on the overseas markets for its revenue more than any other sector. And so it's sort of on the front line of what is happening in the overseas markets, what is happening in the trade dispute, the strength of the dollar. All of those variables that you mentioned, I would argue that the tech sector is more vulnerable than any other. And so that's the Achilles. And also, while we're at it, let's not forget about regulation. I mean, it seems to me that of the sectors, the one sector that is most on the front line of the regulatory risk in this environment, and particularly in the crosshairs of the 2020 discussion, presidential election, is tech. So there's a lot of reasons to worry about it. And look, if you asked me, I would tell you that I don't see how this tech rally, this modern day tech rally continues. The only question is whether it has a final burst as it did in 1998. And if it does, that can cause a lot of investors behaviorally to do some very silly things. They did it then, and they'll probably do it again.
All right, I like it. The behavioral risk always still hanging around in markets. Nir Kaissar, great stuff, really good analysis. Enjoyed the piece as always. Thanks a lot. Nir is portfolio manager at Unison Advisors. Go check out the story on Bloomberg.com.